Hey everyone, welcome back to the Weekend Charts. I'm your host, Charlie Bilello, and as always, I'm going to be running through the most interesting charts and themes in markets and investing. A lot to talk about this week, but first I want to touch on this webinar that Peter Maluk and I are doing Thursday, April 20th, 12 p.m. Central, 1 p.m. Eastern. Huge topic here, very important for investors, why you should avoid market timing. Well, market timing is one of the biggest mistakes investors often make. And so we're going to be talking all about what to do to avoid market timing and what you should be doing instead. So be on the lookout for that. I'm going to have a link to that in the show notes and hope to see you there. So let's start out by talking about the inflation report, which is really just a continuation of the trend we've been seeing with inflation in the US moving lower. But before the report, I like to put out this poll, just getting an idea of what people are expecting going into it. And not that many people were thinking it would beat the consensus estimate, which was 5.2%, which is a meaningful drop from the 6% we saw the month before. But the report actually came in at 5%. So, really, an upside surprise, better than expected report, meaning inflation was lower than expected. So, US CPI now at 5%. That's down from a peak of 9.1% last June, which is, of course, a 40-year high, highest since the early 1980s. Now, that's the ninth consecutive decline on a year-over-year basis, lowest we've seen since May 2021. Now, the core rate of inflation did tick up a little bit, and we'll talk about the reason why. And big reason is that housing inflation number continued to move up. But overall, pretty good report. Markets were pretty, I think, happy to see inflation continue to trend lower. So if we look at the major components and we compare them to last June, what we're seeing is most of the major components showing a lower rate of inflation than last June and by a wide margin, particularly the energy space here. And we've been talking about commodities and how we're going to see these year over year changes become much more favorable. And now we're really seeing it in the reports here with fuel oil and gasoline down double digits on a percentage basis in this latest CPI report. Last year, they were up huge. Gas utilities really starting to come down. We've talked about natural gas, the price of natural gas really collapsing. So this, I would think, should continue in the months to come. Electricity finally coming down. Food at home, big one here. We're starting to see a meaningful decline finally there. New cars, used cars down. Used cars actually down on an absolute basis. And if we're looking at components that are really higher than last June, you only have a few. Transportation being one of them. Big part of that is airfare. Costs have gone up significantly over the last year. Food away from home, so a big part of that is service component, so wages at restaurants, and so that's continuing to put pricing pressure at food away from home. But the biggest one of all, of course, is shelter. And shelter, as we often talk about, is the most important component in CPI by far. 34% of the index. It's simply what most people, most American households spend the most money on. So what we saw here for shelter CPI is a move up to 8.2%. That's the highest we've seen since the early 1980s. But, and I sound like a broken record here because I've been saying this for the past few months, every month, shelter CPI is a severely lagging indicator. So if we compare shelter CPI, that's the orange line here, with US rents, so actual rental data, they're moving in opposite directions here for quite some time. So what we're seeing is actual rents moving down on a year-over-year basis, a lower rate of change. And we'll talk about Redfin's data later that actually shows a negative rental change on a year-over-year basis. But we're seeing that shelter CPI component continue to move up. So the question is, when is this lag going to be over? When is shelter CPI going to finally be taking into account this real-time data that's showing rents are coming down and home prices are coming down? I suspect it'll happen sometime this summer, in the next few months. We can't say for sure because we don't know the exact numbers that you're using, the methodology here. But I suspect it's going to be soon. And when that happens, given shelter's huge weight in the index, that's going to have a big impact on that core rate of inflation and the overall rate as well. But if we're looking at why shelter CPI is still going up, it's really a story of playing catch up. So shelter CPI had understated the move higher in inflation and housing inflation in 2021 and the first half of 2022, and now is trying to close that gap between the two numbers. And I think this could continue, let's say, for a few more months. I don't think that would be surprising. It's using leasing data, so rental data. People are coming off their lease, and as new leases are issued, you're seeing a continued rise in that. They're also asking people what they would rent out their homes for. That's owner's equivalent rent. And so these polls could continue to say that prices are higher, but I think we're getting closer to the point where we're going to see a moderation in that housing inflation number, and then we're going to start to see a move sideways, and then eventually, assuming that the home price data and rent data continues to be soft, we'll start to see shelter CPI move down, but that's probably not going to be a story until later this year. So if we're looking at inflation globally, it's a really last year all of this was in red, so we were seeing higher rates of inflation across the board, in the US, of course, in Europe, pretty much everywhere, emerging markets. And now we're seeing the opposite trend, where we're seeing particularly the commodity prices, but other prices as well, finally softening, and we're seeing that globally. So US down to 5% here, but we're seeing almost everywhere seeing lower rates of inflation. That's obviously a good sign. And if we look at central bank policy, we're getting closer to neutral policy in many areas. In some areas, especially emerging markets, if we look at places like Mexico and Brazil, we have tight policy with the central bank rate significantly above the inflation rate. And the US, as we've talked about, is getting very close to that baseline area where that Fed funds rate meets that CPI. And I suspect we're only a month or two away from that crossing above it, assuming that the Fed doesn't start cutting interest rates, which we'll talk about next. So let's talk about what the market's expectations are. Market is expecting one more rate hike now. And again, this has been fluctuating back and forth pretty much with every data point, but pretty interesting that better than expected CPI reading didn't lead to a change in expectations here. In fact, market now is saying 80% probability that the Fed is going to hike one more time above 5%, so 5 to 5.25%. And that would be the highest Fed funds rate we've seen since September 2007. So significant. We're getting close to that 5% level. Market saying Fed is going to push it above that level. And if they do that, going to be likely above CPI, assuming CPI comes in lower in the next reading. But this has really been the path that has surprised market participants over the last year. The fact that the Fed has hiked every single meeting and has hiked aggressively as they've been. But the market here is saying we're almost done, just one more hike. And this is where you get a lot of pushback, and I think rightfully so. People are skeptical that the Fed would move 180 degrees like this, but they're saying sometime this summer the Fed's going to start cutting rates, and those rate cuts are going to continue throughout this year and into next year. Now, as we've talked about, these expectations can change vastly from month to month, and given that the Fed is signaling a lot of this, well, if they make an affirmative statement that they're not going to be cutting rates at some point, well, this could change dramatically. Or if inflation ends up being higher than expected, obviously this curve will change as well. But interesting to see this. I think the market is saying that there's going to be a recession this year or at some point, and that the Fed is going to respond to that by cutting rates. I think that's what the market's predicting, but we'll see if the market is correct. Now, if we look at the Federal Reserve's assets, as we talked about, it had been a steady quantitative tightening since the peak last April in terms of their balance sheet. Then we had that Silicon Valley bank failure. Fed provided all this liquidity with loans. And over the last 3 weeks, we've seen that come down. So we've seen a moderation. So it appears to be that the emergency is over for now, but we'll watch this closely week to week. Obviously, if there's another bank failure that happens or something else, this could change. But I think, again, as I said last week, the Fed wants to see this come down. They don't want to have to increase their balance sheet at this point. They want to see a continued runoff. So something to watch closely. Interestingly, the balance sheet is higher than where it started the year. So we talked about entering the year, if the Fed was going to run their quantitative tightening as planned, this would be the biggest percentage change decline that we've seen with data going back to 2002 in the Fed's balance sheet. But as we can see, there's many surprises in markets, and of course, the second and third largest bank failures really changed things, and the Fed providing that liquidity. So we'll see what happens with the balance sheet. I think the Fed wants to keep that being a temporary emergency measure, and they'd like to see that balance sheet continue to run off. So, what are some other signs of lower inflation? What are some signs that the Fed can pause if they want to at the May meeting, even though the market's expecting another hike? I think the Fed has enough data if they want to at this point to say we could pause for a month and just reassess and see what happens. But even if they do that hike, I think just given the growing signs of lower inflation all over the place, that they'll have room to pause after that meeting. Let's say they hike one more time. So producer prices now down to 2.8%, lowest since January 2021. We have these business inflation expectation survey that the Atlanta Fed does, down to 2.8%, so moving lower. This is a big one that I've talked about a lot, but now we're finally back to pre-pandemic levels. We're actually below levels before COVID. If we go back to February 2020, we're actually now lower in terms of global freight rates than we were back then. So just a stunning collapse in prices, 87% decline from the peak in 2021. And this is going to start to filter into prices slowly, but surely. I think it's going to be happening. And if we look at import prices, now we're actually seeing a decline on a year-over-year basis, 4.6% decline. That's the lowest since May 2020. So, number of good signs here. Then we have rents, and this is real-time rent data out of Redfin. So this is asking prices for rents, for listed rents, and that's down now year over year for the first time. You have to go back to March 2020. So we had this enormous spike higher in asking prices for rents, then this continued trend lower, and now we're actually negative on a year-over-year basis, first time since 2020. And this is going to be a factor, again, with a lag into that CPI. But the Fed, of course, is watching this real-time data. Even if they're not talking about, they're certainly watching it, I would think, closely. And if it continues, it's likely going to factor into their decision making. So the Fed doesn't usually do this. I can't remember a time where the Fed has talked about a recession before we were pretty much already in it, but maybe we are. But the Fed is now forecasting a recession. We got the Fed minutes, so the minutes from their last meeting. And what they said was, given the assessment of the potential economic effects of the recent banking developments, the staff's projection, the staff being the Federal Reserve, at the time of the March meeting included a mild recession starting later this year with a recovery over the next 2 years. So, very interesting. Fed saying now there's going to be a mild recession this year. Now, the market's still saying that the Fed's going to hike one more time, but I think that might be part of the expectation that the Fed will then cut rates at some point and continue to cut rates. Because if we get a recession, you're going to see a decline in demand and you're going to see a softening in prices. That's what you tend to see, as we'll talk about in a little bit. So, Fed's talking about the banking sector and that causing pressure on the economy. And why would that happen? What we're seeing here is a big decline in bank deposits. So this is a year-over-year rate of change of bank deposits in the U.S., largest on record, with data going back to 1974, largest decline, down 4.9%. So banks have less deposits. Implication is banks are going to lend less. If we look at small businesses, indeed, this is what people are saying from small businesses. The NFIB does this survey every month asking about a number of different conditions for small businesses, but one of them are credit conditions. So the availability of loans, and you're seeing just a sharp decline here. If you look at that March number, you have to go back quite some time to see credit conditions this bad. So the implication is credit conditions are bad. That's going to lead to economic weakness, and the Federal Reserve is going to be mindful of that. And the market's saying the Fed is going to cut rates because of that. So all of that, it remains to be seen if that'll play out, but that seems to be the expectation. And I think the biggest indicator, let's say, of real time data that's showing weakness in the economy, and the most important one, this is one I've been talking about for months, but it's really now front and center, is retail sales. So, US consumer, biggest part of the economy, by far, biggest driver here. And you're finally seeing signs that the US consumer is pulling back. And we've talked about all of the reasons why this was likely last year in terms of the decline in the savings rates, an increase in credit card borrowings. At a certain point, the consumer was going to start to be nervous or have an inability to borrow, and they were likely going to pull back. And here we are, and we're seeing it right now. So 1.5% increase in nominal retail sales, lowest since May 2020. But in order to give the true picture, you have to adjust for inflation. So when you have inflation as high as it's been over the past year, over the past few years, you have to adjust these nominal sales in terms of higher prices to see the actual change in demand. What we're seeing here is the lowest year over year inflation adjusted retail sales that we've seen since April 2020. So a 3.3% decline. That's now 7 months in a row where we have negative year over year real retail sales. So, kind of a persistent trend that after adjusting for inflation, consumers are spending less. And so, that's a classic kind of recessionary sign. Is it possible to have a recession without one? I suppose it's possible. But the more this kind of stays in this territory, the more evidence you have of a potential slowdown. And what's one of the big reasons why the US consumer is pulling back here? Well, we've talked about it. 24 consecutive months of negative real wage growth. So wages not keeping pace with higher prices for now 24 consecutive months. That's a long time. And so certainly part of that gap we've talked about has been filled by consumers saving less. Part has been filled by consumers borrowing more. But each and every month that becomes more difficult. And on the borrowing more side, it's becoming more difficult to service that debt because the interest rate on that debt is simply going up rapidly. So now we have new credit card data. The average interest rate on credit cards in the US has moved above 20% for the first time. Only a year ago, we're looking at rates at 14.5%. So big spike. That makes a difference. Obviously, if you have more to pay in interest, you have less to spend on other things. Obviously, the availability of credit, so new borrowing is going to be more difficult if banks have fewer deposits. So I think this is going to start to filter in. We haven't seen the full effects of this just yet. And if the Fed does hike again in May, this rate could go even higher, right? So we might not be at the peak in terms of credit card interest rates. So this is really the chart where you have to ask yourself, is this time different? So I've been showing this chart for some time, but now we're finally at the point where monetary policy is almost at the tightening level, depending on how you view inflation. We're either there or almost there. But every time in the past that CPI has been above 5% and the Fed has hiked interest rates to try to bring it down, as it's doing today, there's been a recession in the US. And so the question, of course, is can we avoid a recession this time with the Fed doing the same thing? The Fed, of course, is hiking interest rates to bring down inflation. Well, how's it going to bring down inflation? Well, it's going to hurt demand, right? It's going to make it more difficult for consumers to spend money. It's more difficult for businesses to borrow. Financing costs go up, and all of that puts pressure on the economy. And you in the past, you've always seen an economic slowdown. So the question is this time different? And it doesn't seem likely. The odds are not high. Anything is possible. But every single time in the past we've seen this, we've seen a U.S. recession happen. The question, of course, is when. I put that question out on Twitter. I've done this every couple of months. And what people are saying now is that we're pretty much either in a recession or heading into recession within the next 6 months. So 83% of people that I polled said one of the two. Most people saying we're heading into recession, so maybe not quite there just yet. Probably looking at that employment data as we talked about, which is still showing jobs growth. still the unemployment rate very low. And so perhaps people are saying a few months from now, but not now. Only 17% saying we're in an ongoing expansion. So we'll revisit this. I put this poll out. I'm going to do it every month and see how it changes. But a lot of people already feeling that we're in a recession or heading into recession. And I think just as the data builds, we've talked about housing, we talked about manufacturing data, retail sales data. Now we have the yield curve data, we have credit conditions. Just a number of indicators are suggesting that we're going to see some economic weakness. Question is when, how much? The Fed is saying it's going to be mild. I don't know how you could possibly predict such a thing. Hopefully that's the case. And perhaps markets already anticipated that last year. So that's really the most interesting thing that we'll talk about at the end of this video is the markets had their deepest declines last year. And as the economic data seems to be getting worse, we're not seeing the market respond in the same way. So very interesting to see that difference there with the economic data worsening, but the market's actually strengthening here. So let's talk about one area that's not strengthening, and this is another concern in terms of adding to the probability of a recession and problems in the economy. It's really commercial real estate market, and if we look at credit spreads for CMBS, so CMBS are commercial mortgage-backed securities, so simply packaging a bunch of commercial mortgage bonds, putting them together, you sell them off and you have this option adjusted spread, which is looking at the interest rate on CMBS and comparing it to a similar duration treasury, so risk free security. And what we're seeing here is a widening. So, when widening means people are asking for a higher rate on that CMBS relative to a risk free security. And that's really been widening very quickly in the last few weeks. And now we're at the widest level since March 2020. So only at the peak during that COVID crash did we see a higher spread going back in the last decade. So the concern here is this is the market is saying there's going to be defaults here. Commercial real estate's going to come under pressure. And a big part of that is concerns about the office sector within commercial real estate. And we're seeing, of course, highest vacancy rates we've seen in a long time. Big part of that obviously is the hybrid now situation that most companies have embraced, where people are not in the office every day, and therefore you have companies when their leases come due, they're not renewing that entire space. They're trying to cut costs, obviously, and that's leading to increased vacancies. So this is likely a cycle that's going to take years to play out. Is it big enough by itself to cause problems in the entire U.S. markets? Maybe not. It's only one sector, of course, the office space. There's obviously hotels. There's within commercial real estate, there's many different sectors. So you have malls, you have apartments, you have many different areas that don't appear to be under that same pressure. But the question is this big enough that's caused problems for banks and particularly regional banks? If you look at the share of loans held in terms of CMBS and that issuance, you see a bigger share in terms of smaller banks relative to larger banks. So is that going to put continued pressure on these banking institutions, which is going to cause continued pressure for the overall U.S. economy and then the markets as well? That's a question people will be asking, I think, in the months to come. Now, let's switch gears, talk about different type of loan here, auto loans. And this has been building for a while here. Obviously, every time the Fed hikes rates, the auto financing rates go up. U.S. consumers have been accustomed to very low auto financing rates for pretty much a decade when the Fed was pursuing zero interest rate policy. But this big move higher we've seen over the past year, really we haven't seen that type of spike in a long time. So we've gone from 4.58% up to 7.46%. That's the highest we've seen in a long time. What that's doing is simply, if you're financing a car, and most people do, that's increasing that monthly payment by a large amount. And according to Kelley Blue Book, we're seeing a near doubling from late 2019. So $777 on average per month for that car payment. That's pretty high. That's a sixth of the median after tax income. And if we look at the percentage of vehicles where people are paying over $1,000 a month, you're now up to 16.8%. That's a record high compared to just 10.3% in early 2022 and 6% in early 2021. So big factor here. It has to affect demand because over 80% of new cars are financed, 40% of used cars. So if it's harder to get financing, you can't afford that monthly payment. Well, the demand has to go down, and so this is likely to put additional pressure on that area of the economy. But we're going to see that everywhere because consumers are financing goods everywhere you look, right? So most people have credit card debt. Most people don't pay off that monthly balance. Over 50% don't pay it off. So now they're paying a higher rate of interest on that. It's harder to get a new line of credit in terms of U.S. consumers. And so that's likely to hit demand. And again, that's what the Fed's policy are intended to do, right? So raising interest rates leads to a decrease in demand with a lag, and now we're in that lagged period where we're seeing it actually come home. So let's talk about deficits. And while the U.S. consumer might be pulling back, the U.S. government certainly is not. We're seeing another increase in the deficit last month, now up to 1.8 trillion. So the U.S. government continues to spend money like a drunken sailor. There seems to be very little concern for the deficit, and this is somewhat surprising given all the talk about the deficit last year and talking about the Inflation Reduction Act, which was supposed to reduce the deficit, but now the data is coming out that maybe it's not reducing the deficit, maybe it's actually increasing the deficit. And so what we're seeing here is the U.S. government debt, even though there's a so-called debt ceiling, the deficit keeps going up. And once that debt ceiling is lifted, you'll see the actual numbers where the national debt is going to continue to increase. Why this is problematic, as we talked about, is you have to pay interest on that debt, and that interest on that debt is going up because interest rates are going up. And so all of this time period where people are saying, don't worry about the debt because interest rates are so low, well, that really ignored the possibility that interest rates one day wouldn't be low. And now we're in that situation. So the interest expense is up to now $812 billion over the last year. And as we talked about, if it continues on at this pace, it could be the single largest item in the federal budget. So the concern is, as a percentage of GDP, this is rapidly increasing, of course, and it could start to crowd out other spending. And it becomes kind of a spiral where you have to borrow more money in order to pay the interest on the money that you owe, and so on and so on. So unless we start to close this deficit and have some fiscal responsibility, I think this is going to be a huge issue. Certainly in the 2024 election, you're going to hear a lot of people talking about this. It's going to become more problematic, especially if the Fed doesn't cut rates like the market is expecting. What if the Fed keeps interest rates at 5% for some period of time, which the market isn't expecting? But what if they do that? What's that going to mean in terms of the cost of financing? And of course, historically, before the financial crisis in 2008, a 5% interest rate wasn't considered extreme by any means. So it's only really in the period after that where we become accustomed to ultra low interest rates where we would view 5% as a lot. So the question is there going to be some fiscal discipline? I expect there's going to be more of a battle, and it's going to become more of an issue in 2024. So let's talk about the price of gasoline. Was moving in the right direction for quite some time. Certainly the whole back half of last year after gas prices hit a record high over $5 a gallon. We had a nice steady decline, and really this year we we started out okay, we went sideways, but now we're starting to trend higher. And we talked about on the last video, OPEC, that announcement that they're going to be cutting production to try to boost prices, and now we're seeing that filter into higher crude oil prices, and now with a lag, higher gas prices. So we're up to 364 a gallon, still better than last year. So there's still, if we're looking at year over year CPI, we're still going to see a negative here for April unless we see a big spike, and an even bigger negative for June. But the concern is that this is going to stay elevated and perhaps continue to move upward. And now we have more inflation pressure, and this is not going to come right back down like people were hoping. So if you look at what the response has been to this increase here and perhaps to the OPEC move, well, the Strategic Petroleum Reserve is being tapped again. So for 3 months, we went sideways. We talked about how last year was a record year in terms of tapping the Strategic Petroleum Reserve. We had 71 consecutive weekly declines from the end of September in 2021 until early this year. Then we went sideways, but now it's being tapped again. So interesting, lowest level since 1983. We'll see if this continues. As I've talked about, it's really irrelevant. The amount that's drawn from this Strategic Petroleum Reserve is less than 1% of daily usage. So it's really almost meaningless, but optically, it's really to say, oh, we're doing something to try to fight higher prices. But it's really, in terms of global supply and demand, it's a global market. It's pretty much meaningless. So if we talk about the housing market, we've talked a lot about residential and primary homes. Just want to touch quickly here on vacation homes and the slowdown here. Probably not a big surprise, but this is interesting data out of Redfin saying that we've seen a 52% decline from pre-pandemic levels in terms of new mortgage rates. So new people getting mortgages for second homes, for vacation homes. So just a huge drop in demand. We went from this epic increase, so people buying more vacation homes than ever before in 2020 and 2021, to really the complete opposite, where we're seeing demand has collapsed. And Redfin went through a number of reasons for this. I think this is being the big one, that second home buyers are simply priced out, right? Prices have gone up so much, not just in terms of primary homes, but second homes as well. And often these vacation homes are actually, if we look at the averages, are higher than the cost of primary homes. And that's simply unaffordable given the mortgage rate situation and how much prices have gone up, and incomes haven't kept pace with those prices. But this is an important point. Obviously, it's not a necessity, so you don't need to buy a vacation home. And when people are worried about a recession and they're worried about inflation, they might be less likely to pull the trigger to buy a vacation home. They're saying that workers are returning to the office, so I think this is a big one as well. If you have a decrease in remote work, you're going to have a decrease in people feeling like they can use their vacation home more and work out of there if people are returning to the office. And then you just have simply the fact that rents, as we've talked about, are starting to go down on a year-over-year basis. And now that's, if you're buying it as an investor, it's not as attractive, particularly because prices have gone up so much. So if you're looking at a rate of return, that's not as attractive if rents are coming down. And simply bank accounts are going down, and the desire to have a vacation home, maybe that's been tapped out. Maybe everybody that wanted a home has already bought one, or most people that did bought one in 2020 and 2021. So a million different reasons. I don't think it's a big surprise to see this, but just another factor, I think, leading to the idea that the housing market is definitely in a recession. The question is how deep and how long it's going to continue. So one area that's not in a recession is auto parts. Really a bull market that continues there. Two major players there, O'Reilly and AutoZone, hitting all-time highs again this week. I talked about AutoZone in the past. It's been one of the best performing stocks in the S&P 500. So has O'Reilly. If we're looking at the last 20 years, just stunning rates of returns for both of these companies. But very interesting to see this and what's driving the trend in really for not just recently, but during the last decade for these companies. What's been kind of the secular trend? Well, that people are owning their cars for longer. And so if we look in 1995, the average age of a car on the road or cars and light trucks, 8.4 years. And now we're up to a record 12.3 years. So there's a few factors driving that. Number one being that cars last longer. They're built to last longer. They're made better, and you can get 15 years out of a car. You can see cars with 150,000, 200,000 miles doing just fine. The other reason, of course, in recent years is that cars have become much more expensive. So if you're looking at a new car, it's become much more expensive. We talked about used cars prices being unbelievably high. Well, maybe you'll put that put buying a new car off for a bit longer, and we're just seeing a continued trend there, and that's certainly been bullish for those two companies. Now, other all-time highs, pretty interesting here. Kind of goes maybe against the idea that we're in a recession. You probably don't see these two companies hitting an all-time high in a recession, or at least it would be a strange one. Ferrari and Louis Vuitton, both hitting new all-time highs here, so recovering completely from the declines in 2022. Very interesting to me to see both of these brands hitting new highs. And if we look at Ferrari, I put out a tweet comparing Ferrari. This was fascinating to me. I just pulled up quickly. Ferrari's at an all-time high. Well, what's it trading at in terms of price to sales, price to earnings, and how does it compare to Tesla? Interesting to me that Ferrari actually had a higher valuation for price to sales and price to earnings than Tesla, with lower revenue growth, much lower, and actually negative net income over the last year. So pretty interesting to me that price investors seem to be paying for Ferrari is very high value at like a high growth company, almost 10 times sales, over 50 times earnings. And we'll see, perhaps they're expecting something huge in the future from Ferrari in terms of the fundamental data driving that. But right now, that seems like an unbelievable valuation for this type of company. So speaking of unbelievable valuations, McDonald's, everyone knows the phrase, I'm loving it. Well, investors are loving McDonald's more than they've loved it ever before. So we have price to sales data here going back for decades. McDonald's has never traded at a valuation this high, over 9 times sales. This really, I had to check this number a few times. It's kind of shocking for this type of company, really considered to be a consumer staples, really, and trading at over 9 times sales. So trading like a tech company, a high growth tech company, in fact, higher than many high growth tech companies. I'm comparing it here to a number of different things. So I'm looking at Yum and Chipotle and Starbucks to look at other restaurant type stocks. So significantly higher than all of those, but higher than Apple and Tesla and Facebook and Google and Amazon. So unbelievable that McDonald's has this type of premium valuation. We'll check this next year to see if this was a burger bubble or something else. But investors clearly valuing McDonald's very highly, expecting big things. Or the other question would be, is this a flight to safety? Investors anticipating a recession. In a recession, people will be spending more at fast foods to try to cut their spending at higher price restaurants. Is that what's going on here? What remains to be seen. We talked about a number of those consumer staples companies trading at very high valuations, so perhaps this is part of that as well. But interesting juxtaposition with McDonald's hitting an all-time high and trading at very high valuations. At the same time, you have Ferrari and Louis Vuitton doing the same. So a lot of conflicting signals in the market. But one other company here, the staples area, Hershey's, also trading at its highest multiple ever, over 5 times sales. Again, once again, don't really know what's going on here in terms of why investors are saying now it's deserving this much higher valuation. But interesting to see that along with McDonald's. And once again, we'll check this. We'll check this going forward to see what happens here. So I want to end with something positive. We're going to talk about the Holy Grail indicator, that being a joke, of course, because there's no such thing as a Holy Grail indicator. But something very positive has been the trends in asset returns this year. So after a really terrible 2022 with almost everything going down, we've seen the complete opposite so far this year with almost everything going up. Uh, Bitcoin, tech stocks, leading the way. You have Europe and Asia outperforming. We have gold doing well. We have S&P, long bonds, emerging markets are up, investment grade bonds, pretty much everything. You have a slight decline in commodities, but everything else doing well. And you're being paid on your cash. So short-term treasury bills, the highest yield since 2007. So if you're an investor, you're feeling pretty good and you held on after 2022, or you bought more on those declines, you're probably feeling pretty good now, and you should be. But interesting here to see the volatility index, the VIX, moving down to 17, lowest level since the first few trading days in January in 2022. That's when the S&P 500 peaked back here, first couple of trading days in 2022. Never hit a higher level. And here we are, well above the October lows, S&P up over 8% on the year. And so the question here is, are we at the low end? Last year, we saw volatility. If you looked at the VIX trade in this range where it went back and forth between below 20 and it would spike to a little bit above 30. Or is this the sign that the markets are going to continue to run from here? Remains to be seen. Just an interesting thing to look at. But I pulled up this chart, something I haven't looked at in almost a year. Had been keeping track of these markets in turmoil specials. That's what I'm talking about in terms of a Holy Grail indicator. It's really the only thing that you can find probably that has a 100% positive return over 1 year forward looking period. So every time CNBC has run this special going back to May 2010, that was around the flash crash, the S&P 500 a year later was positive. And last year they only did one that I could find on May 5th, and the S&P was at 4147, and the S&P last year broke below 3500, so it didn't seem likely that we would see a positive return here. But we're almost there. We're just below this level right now, so we'll see in a few weeks. We still have a few weeks to go. If the streak will continue, and we'll see once again a positive return here. Obviously, this is not an indicator to be traded on, but this is something that reflects sentiment and contrarian thinking. If they're talking about the markets in turmoil, the market likely has gone down significantly in the short run. And what you tend to see in any 1 year period, you tend to see positive returns, but particularly after sharp declines, you tend to often see better returns going forward. That's what we've seen in the past. As I've always cautioned, there's going to be a time, if there's a long bear market, where this indicator doesn't work. It looked like last year this would be the time, and maybe it still is. But we'll revisit that in early May to see if the Holy Grail indicator continues the ultimate contrarian signal, the CNBC markets in turmoil. So under right there. Thanks everyone for joining. Have a great weekend. If you like the content, subscribe to the channel, and I'll see you next time. Thanks.